I want to start because a lot of people draw parallels to 2008. And given your experience there, you were chief economist, top-rated economist at Bear Stearns. Are there parallels to that moment and the one we're in now?
I think there are parallels and differences. The parallels are there was really a maturity mismatch at some institutions, and the Fed had been raising rates. Remember, a long period of rate hiking leading into '08. But then some big differences. One is this time the discount window is available to the major institutions. That wasn't the case then, and so that gives some backstop, and you're seeing it really play out now. And another big difference is the Fed itself is buying huge amounts of duration, and other central banks are as well. ECB and Bank of Japan are holders of giant amounts of duration, which wasn't the case in 2008. They at that time, remember, central banks only owned Treasury bills. So that creates a different complexion to the market and a different set of tools that the regulators have to intervene. So today, I think the big issue is where is growth going to come from into the future?
Before we get to that point, I know you want to bleed that over into the rest of the world, which is an important point. I want to talk about the similarities. You talk about a liquidity mismatch. A lot of people draw the distinction. A liquidity mismatch is not a credit crisis, is not a credit crunch. But back in 2008, and actually I would argue earlier, the liquidity mismatch led to a credit crunch. How close is that sort of direct parallel, this sort of direct bleed over into credit conditions?
As interest rates are held down, which was the case in '04, '05, '06, and now in this current or over the last 10 years, then that causes asset prices to go up. So there's a workout period after that. So I think that's what we're in now. How do you adjust asset prices if yields are going to be much higher than what you thought 2 years ago or 1 year ago? And that's the challenge facing the market. How do you allocate the losses? I'm hoping that they don't go to the poor, to developing countries, and to average taxpayers. An issue is if you've created all that asset price boom, can the losses be allocated back into the same markets? And that's a big challenge.
So could you elaborate a little bit on the disproportionate holding of the burden that you see in some of the developing nations that may affect the growth profile of the world?
Over the last 10 years or so, there was this big concentration of wealth in a narrow group in the advanced economies. That was fueled by both the fiscal deficits, the huge run-up in the debts across the advanced economies, and also the central banks themselves buying duration. That supports asset prices. Long-term assets go up when there is a giant buyer, constant buyer of those assets. And so that leaves not enough capital elsewhere in the world. We've seen the slow growth in developing countries, in part because there's not good access to global capital markets. And now going forward, the challenge is a lot of the world's capital is going to be used by the advanced economies to keep rolling over the debt. So a big challenge for billions of people around the world is where is there going to be available capital? They have this big population growth in many countries, and yet the capital goes to countries that have declining populations.
So how much does that lower your projection for global growth? And how much has that lowered it even over the past couple of months?
We had lowered it substantially a year or a year and a half ago, recognizing that there was, inflation really was a challenge, that the central banks were going to be raising, cost of capital goes up, so growth forecasts go down. So in the latest, what we've seen is advanced economy growth expectations had gone up some late last year. That's the U.S. and China in particular, as China lifted the embargo, the lockdown, and so as we're looking at it now, the growth is slow but positive in advanced economies, but in developing countries, not much investment taking place. That, I think, is the big challenge. I'll be giving a big speech tomorrow at CSIS in Washington, D.C. on the importance of private capital enabling. What are the tools and techniques, and the World Bank's in the middle of it, trying to get countries to be more attractive to capital investment.
In the meantime, we do get this Fed decision later today. How does that connect to the stripping out of capital from some of the developing world? If the Fed does go ahead and hike rates by 25 basis points and increase their forecast for where the terminal rate ends up, what kind of magnified effect could that have?
I heard you talking before. They'll be sending signals of what the prospect is. I think important is for the U.S. and the advanced economies to think about how do we encourage more supply, and that brings down the inflation rate. So central banks can be more involved or recognize they are affecting the lending that goes to small businesses. And so are there ways with regulatory policy or with the bond, with this duration purchasing that the central banks do? So my view is that when central banks buy duration, that actually ends up slowing growth on average. And if you look back over the last 10 years, there's been this anomaly that they're buying huge amounts of bonds, and yet you're not getting the growth rate that you expected from that. So going forward, I think there has to be a really deep dive into how do we get more growth and capital allocation worldwide.
Until then, given that all things being equal, a lot of central banks are turning to the same playbook, and you're actually seeing the balance sheet re-expand in the U.S., how slow could global growth get?
Yeah, I think it can be even a recession, and that's not off the table. The latest
global recession.
You could have a global recession. We define that as when the growth rate isn't equivalent to the population growth rate. So you have people moving backward on average. That depends a lot on the advanced economies. The U.S. is by far the biggest economy, and so its growth rate matters. And so people are watching exactly what's going on in the loan officer survey, for example. There was just a reference to that on your show. That's an important one. Are banks lending given that they see these difficulties?
So all things being equal, are the chances of a global recession much greater today than they were 2 weeks ago?
No, I would not say that. There was a recognition of individual bank problems. They were strongly dealt with by regulators. So the bigger issue, rather than looking at the near-term impact, I think we have to just stay with the idea of what's going to be done for the next 3-year growth rate of the world. How do you get out of this kind of trap of higher and higher interest rates? And I think the solution has to be more output. How do you get more services, more goods into the global markets in order to stop the inflation trend?
Given that, what do you hope Jay Powell does today?
No, he's the policymaker.
You're like, thank goodness
I'm sure he's going to
it.
send very strong signals.
Well, I'm sure, and I'm sure people will read into them.
Yeah.
And why are you in New York?
There's a big UN conference today on water. Water is really important. Clean water for people. It helps children grow to their full height, and it helps agriculture be able to produce. So big conference on that. And I'm also doing other events in New York.